Hi, and welcome to another episode of the CostofCarry podcast. My name is James Chi, and let's get started. What does set and forget mean? This is a common phrase that some lenders like to throw out when they pitch loans to new customers as well as brokers. And basically what set and forget means is that once the loan settles and gets all processed in the background, there are no longer any maintenance checks or any annual reviews that the loan requires until maturity. And this is in contrast to a loan that has an annual review period on it. And basically what the difference is that every time that annual review gets conducted, the borrower has to pay a cost for that review to take place. And the trade-off to that review taking place is that the rate is more often than not cheaper than the one that offers a set and forget facility. And this is the price of certainty, I suppose, on the borrower's behalf, because the lender has no guarantee that the borrower's circumstance won't change over the life of the loan. And so what this allows then for borrowers who don't feel like always providing tax returns to their lender or conducting a new valuation report on their property, the ability to relax knowing that their loan isn't going to get called on or is going to get changed in terms of pricing. And I think for the most part, the difference in percentage can be of benefit in this regard. It's just a matter of convenience for what most borrowers prefer, I suppose. And if however a borrower or applicant is prepared to continue doing a review on their loan on a recurring basis until maturity, then that's fine as well. It's just a matter of preference. Second point is it possible for finance to go paperless? For the most part, I believe it is possible. However, the main barrier to this happening is the legal aspect of things, which require wet signatures. Finance can be digitalized and done through virtual means. For example, we can verify identification through different agencies as well as through video calls, as well as secure photo identification apps such as Zip ID. Also, we can collect bank transaction feeds from the applicant by them giving the broker or the lender permission to a third-party app to access that information. Similarly, we can also use regular digital software apps such as Word, Google, Dropbox, Evernote. If you think about it, there isn't anything that technology doesn't cater for yet, apart from it being mainstream. That's the only thing that's preventing the adoption of a digital finance experience. And until this happens, we are gonna have paper involved in the process. And this isn't necessarily a bad thing. It just creates a little bit more administration, I suppose, that's involved. And that isn't to say that administration is anything different from what would happen in a completely digital process. It's just that we now need to have physical storage as well for that administration. So if we consider cloud and local storage in a technology perspective, the cloud allows us to have anything accessible from multiple devices, whereas local storage means we can only have it located in one device. And so what this poses is that for brokers to have offices around Australia, as well as brokers to also interact with customers around Australia, whether or not they are located around Australia is beside the point, but if they want to have a broader reach, having a digital process and a digital method of conducting the application process is necessary. Types of business financing. Now, for the most part, business finance can be very straightforward when it comes to purchasing, refinancing, cashing out against properties, as well as construction. However, there are some things that business lending can get tricky with, especially when it comes to things like asset and equipment financing, trade finance or debtor finance, business finance can also involve a group structure, which can be difficult, especially when you're looking at different guarantors and directors and shareholders. Because of all these complexities and variations of what a business loan can look like, each lender has developed a product range that reflects what they're comfortable lending with. And so not all lenders will cater to the same things, and similarly, not all lenders will cater to all types of lends. And so by that token, that's where the value of the broker is created. In this search for a suitable business product, the broker is able to research the market and also provide their clients with a solution that adequately addresses their needs, whilst also being able to help them in submitting that application. So business financing can be a means of diversification for most residential brokers. However, it does require a bit of knowledge and understanding of what your current customer base is, what you would be comfortable writing in the commercial space, and also understanding how business financing works. And to further that point, commercial lending is a completely different process when it comes to assessment criteria and supporting documentation. As I mentioned before on the topic of group structures, supporting documentation for that will include ASIC reports, company statements, financial statements, company bank statements, possibly trust deeds if there's trusts involved in the group structure, additional financing statements that the group or the company applicant has in its name. So for example, if the company also has asset and equipment financing, then that may also be required. If there are any legal matters or probationary issues with the directors who are on the loan. In addition to that, when it comes to the assessment, because commercial lending is often done at a higher rate than residential lending, the assessment rate is often going to be somewhat trickier to satisfy unless the business is self-sufficient in that respect. So if it shows that it has enough turnover to satisfy the servicing requirements of the loan, then that shouldn't be an issue. The role of the broker is to provide credit guidance so that borrowers can understand the power of leverage. And what that means is the broker is there to help the borrower or potential borrower figure out what's best for them. And that may sound ironic, given that the broker knows what they want. However, the borrower doesn't always understand what else is available other than their needs sometimes, or their wants. So part of the broker's role is providing that guidance and assistance to help them narrow down their shopping list to what best equates to their ideal loan product. And I suppose leverage in this case refers to the broker's ability to provide that assistance in a timely and professional manner. I know sometimes people can think it's always possible to do it DIY, and that's true. For simple, straightforward scenarios, being able to do your own loan is possible. However, in situations where the application requires a little bit more analysis and a little bit more assessment because there are additional factors that affect the quality of the loan, such as outstanding debts or a bad credit score or high LVRs or existing debts, the broker is there to provide that support and assistance in both structuring the application so that it can be more manageable. Brokers should also ensure that the loans that they are writing are sustainable so that not only they can continue to be paid on them, but also that the borrowers will come back or will refer more business to them. And that's part of the customer life cycle or the business life cycle of the mortgage broker. We want to ensure that our client base is well looked after, which means that having knowledge and having insight and having good networks and good relationships with BDMs is the power that we can leverage in order to provide a better service than what they could otherwise do by themselves. And lastly, what is the opportunity cost of capital? So in that phrase alone, we've put in a couple of terms that could be left on their own. So for example, opportunity cost and cost of capital. Combining them together, opportunity cost of capital, this refers to the timeliness of accessing money. If, for example, you need to settle urgently on a loan, otherwise you will lose your deposit for a house you just purchased, what is the price that you are willing to pay in order to save your deposit and also keep your house, but also make sure you get a good deal? And that's something that borrowers don't always understand as something that goes into the interest rate structure of a loan product. So if you look at, say, private lending, for example, the rate can be very high and very steep and somewhat unattractive. However, if you look at the timeliness and speed that can be offered in dispersing those funds within the next 24 to 48 hours. If you are desperate for money and know you can repay it and you know you have an exit strategy, then that steep rate or that high interest rate is something that should be considered in making sure that your deal or project can go through. Similarly, if we look at a construction deal, so say you want to build townhouses or apartments, what would be the opportunity cost of capital of starting 6 months earlier with a higher rate and being able to finish your project before the end of the year and get it ready for listing, compared to waiting 6 months and getting a cheap rate but taking longer to construct? Obviously it depends on circumstances, but having delays in construction can be more costly than actually constructing. And what that means is sometimes you are delayed by weather, you are delayed by the market, in that sometimes you build and then you're left holding your inventory. What really matters, I suppose, in construction is the ability to get your projects underway and then also be able to turn them over quickly and realize a return rather than wait for the perfect deal to come and fall in your lap. It doesn't always have to be about price, and this is something that I am starting to learn about more and more as I read about these notions of loyalty taxes and additional group borrowing. The opportunity cost of capital really depends on being able to deliver a service that has the option of being exited, and that exit strategy could be related to refinancing to a cheaper rate. What this means is that being able to get a fast solution is often the stepping stone to getting the deal done, because without settling a deal, there is no deal. You lose your deposit and lose your house that you just purchased, or you wait 6 months and then the market for apartments dissipates by the time you finish construction. The opportunity cost of capital is something that borrowers and brokers need to consider all around. It's an interesting topic of conversation to have, and I look forward to learning more about it. So let me rephrase something back there. The opportunity cost of capital isn't always necessary, I should mention that. Sometimes it is for prepared borrowers and disciplined borrowers. The opportunity cost of capital doesn't apply because you've already prepared and budgeted for what you want, and so there are no surprises for when you want to go and purchase or finance something. However, if you come across something and it's not necessarily an impulse buy, but it's caught you off guard and you need to be able to deliver or raise some money quickly, this is where the opportunity cost of capital comes into play. And I personally think this is a very interesting topic when it comes to project feasibility, and it's something is crucial to some deals going through and some deals falling over. And on that note, that concludes this episode of the Cost of Carry podcast. Thank you all for listening. See you in the next episode.